Hi there. In this topic video, we're going to be focusing on the market mechanism again, and this time thinking about the factors that affect market supply. Now, whereas demand refers to the consumer, supply refers to the firm or the producer. Supply is the amount that the producer is willing and able to sell at different prices in a given time period. So our focus today is going to be on market supply, and the key to understanding this section of the course is to be aware of the importance of the profit motive and also the importance of costs. So a basic definition of supply. Supply is the quantity of a good or service, in other words the volume of a good or service that the producer is willing and able to supply onto a market at a given price in a given time period. The basic law of supply states that more will be supplied at a higher price than at a lower price. So this is shown to us by the supply curve. Now, we normally assume that as the price goes up, producers are more willing and more able to increase or expand their production. So why? Well, first is to understand the profit motive, that higher prices will encourage increased production by existing profit maximising producers, and new producers may enter the market again motivated by higher profit. So profitability is a key driver of the level of production. A second factor is the nature of cost, that when a firm expands its output, it's likely that their production costs will tend to go up, and therefore the producer or the supplier needs a higher price to cover those extra costs of production. Now, this might be due to the idea of diminishing returns. As we add more factor inputs into the production mix, we get less extra output. In other words, the marginal or the extra cost of supply might be increasing. Third factor, of course, is that entrants come into the market incentivized by the prospect of making a decent profit. So normally we can assume that at higher prices, supply will be greater. Here's an example of supply in action. Adidas, of course, is one of the world's biggest sportswear companies. They make millions of pairs of shoes every single year. 2009 was a year of global recession for the world economy. And note here that Adidas scaled back their production of shoes quite sharply from over 220 million pairs in 2008 to just 170 million in 2009. Since then, of course, production has increased again as demand has recovered. But here's a really good example of a global company scaling back supply quite quickly when world economic conditions deteriorated. So here's our basic supply curve idea, which shows the law of supply. A rise in the market price brings about an expansion of supply. And keep in mind here that a movement along the supply curve is caused only by a change in the market price. We're holding all other supply factors constant. We'll change those in a minute or two. However, if the price goes down in the market, we expect to see a contraction of supply. Producers may respond to lower prices by holding back some production. Now, it's quite important to understand the idea of market supply. Market supply is the total supply of a good or a service that is brought to the market by all producers at each price. To do that, we simply sum the individual supply schedules for a firm. So, for example, if the price is £10, firm A might supply 30, firm B might not supply at all anything, firm C 5, so the market supply will be 35. If the price goes up to 20, then firm B comes into the market, and both firm A and firm C increase their supply. So at price 20, the market supply might in this case double to 70. So market supply is the sum of the supply of the individual firms in the market. They're responding to price, and of course if new firms join the market, then market supply will increase at each price level. Little point at the bottom there, supply is not necessarily the amount that is actually sold, because of course we need to think about the level of demand as well. So if supply, actual production is greater than current demand, firms will see an increase in their stocks. Here's a good example of cost as a key factor affecting supply. This chart shows the production costs of some of the Star Wars movies, and not every time, but pretty much the costs are getting bigger and bigger with every film. I think the most important thing to do is to make a distinction between the actual expenses involved in making the film, filming it, and the post-production costs, CGI, marketing, etc. But clearly in this case, the supply costs are enormous, but potentially, of course, the revenue from millions of people watching the films, both in cinemas and at home, streamed online, are enormous too. So what causes a shift in the market supply curve? Let's go through some of the key factors. If you want to understand supply, understand cost. So the unit cost of production is the key factor affecting the supply curve. If unit costs go down, a business can supply more of a product at each price. That might have been caused, for example, by an increase in labour productivity. If the unit cost goes up, there's an inward shift of supply. Perhaps, for example, a business has been affected by a higher minimum wage or an increase in the price of an essential raw material or component part. So changes in the unit cost are the key to understanding supply. The exchange rate can also affect market supply. So, for example, if the exchange rate depreciates, the price of imported components, raw materials, also goes up, and that can affect supply conditions. Over time, as technology improves, we would hope and expect that better technology and innovation causes an outward shift of supply because the unit cost has fallen. And as we've mentioned, the entry of new firms into the market, the entry of new suppliers, will also bring about an outward shift. In many markets, of course, climate plays a role, so the yield in things like tea and coffee production will be affected by climatic conditions. Floods and droughts can cause an inward shift of supply. And finally, point 6 is important, that the government, through intervention in the market, can also affect the market supply curve. So indirect taxes on producers, which increase their costs, bring about an inward shift of supply. Whereas a subsidy is the opposite of an indirect tax. A subsidy to a producer lowers their unit costs and causes an outward shift of supply. In many industries, regulatory burdens on health and safety and other aspects, including the environment, can add to a firm's costs and cause an inward shift of supply. Let's have a look at how the supply curve might move. So, for example, this is the market for beef. Let's assume there is a fall in the cost of fertilizer, for example, and other feeds used in the cattle industry. That would bring down the unit cost for beef producers and cause an outward shift of supply. Maybe more beef farmers entered the market. The supply curve will shift if there's a change in a non-price factor which affects producers. In this case, for example, the unit cost of feed. An inward shift of supply would be caused by a rise in costs, an increase in production costs. So higher labour costs, for example, could cause supply curve to shift from S1 to S3. Key evaluation point that how much the curve shifts depends on the significance of the cost. If one thinks about, for example, catering and cleaning and caring industries, the labour costs are likely to be quite a hefty chunk of the total costs. So changes in wages relative to productivity can have quite a big effect. Just finally, I want to talk about something called joint supply. Joint supply is where an increase or a decrease in the supply of one product leads to an increase or decrease in the supply of a byproduct. So this is all to do with byproducts from production. And there are some examples there on the graphic. If we increase beef supply, for example, that in turn will lead to an increased supply of beef hides. Conversely, a contraction in the supply of lamb will also reduce the supply of wool. So think about joint supply, where an increase in the decrease in the supply of one product leads to a change in the supply availability of a byproduct. Here's a good example of a factor which affects supply costs. If we take the food industry, for example, cereal producers, pizza makers, what have you, the world price of wheat will be an important resource cost. So, for example, if the price of wheat is falling, as it has been in recent times, that should in theory increase the market supply of cereal at each price level and increase the profitability of doing so. So there we go, we've looked at an introduction to supply theory. The key is really to understand the profit motive, the importance of that, and also to understand the factors that can cause a change or a shift in the position of the market supply curve. Thanks for joining in on this one.